my name is Mike, and I'm the Chief Investment Officer here at Lighthouse Financial Services. And I'm with you today to present a special market update based on the Federal Reserve's interest rate decision delivered yesterday. So a lot of market volatility. I thought I would kind of put some context and some color around what happened, what was decided, and how we're reacting to that. I'm going to go ahead and share my screen now. The Federal Reserve's announcement yesterday regarding how it plans to deal with interest rates and inflation going forward, I think can broadly be classified into three big areas: inflation, interest rates, and economic growth. And I'll say at the outset that this sort of was a shocker to investors, and it pushed around bond and stock and commodity markets, primarily because the Fed essentially revised some of their prior guidance to say, hey, you should expect going forward higher interest rates, sticky inflation at an elevated level, and lower growth. And that's the trifecta of what investors don't necessarily want to hear right now. So let's get into this. The first category is inflation. And of course, that's the Fed's primary goal, and they just stated it ad nauseum yesterday. What you should understand about the Fed, first of all, is that it uses language as a tool, as a policy tool. It tries sometimes to talk down markets, stock markets, bond markets, by threatening to raise interest rates, threatening to remove liquidity from the economy. And so with regard to inflation, the Fed's surprise was that it said it believes that although its preferred gauge of inflation right now is sitting at 4.6% and its target is 2%, it said it believes that it's going to take, at least a couple of years or more to get it down to that target level. And in fact, it said, inflation hasn't fallen near as much as it has expected so far this year, and expects that 4.6 to come down to about 3.1% a year from now. So there's still light of day between 3.1% and 2% even a year from now. Okay, so I'm going to move forward to a chart here that shows you the blue line is essentially what that 4.6% represents. This is the Fed's preferred inflation gauge. And you can see, by the way, it's very easy to see that inflation has peaked here in 2022, and it's headed down meaningfully. But the Fed is saying that's not even close to being enough, fast enough for our policy decision to change. So whereas I think most investors look at this and say, what's the problem? What are we scared of? Inflation definitely peaked and it's coming down. The Fed is saying, well, that's not near enough. Now, before I move on to interest rates and growth, I'll say, the bond market is saying something very different right now. The bond market is implying that inflation is going to fall to 2.4% average over the next 2 years. So if it's 4.6 now and your average over 2 years is going to be 2.4, guess what? You're ending that 2-year period at or below the Fed's target rate. So again, I think investors aren't scared of the boogeyman anymore. The boogeyman being inflation. It's the Fed that is still on the warpath. And just want to put a finer point on that. This chart shows you, and I'm looking at the blue line, it shows you trading activity in the Treasury inflation protected bond market, so the TIPS market. And you can see here, the blue line is falling off the map, and that's why I say inflation is expected to be about 2.3, 2.4% over the next 2 years on average. These are, bond investors that are putting their money where their mouth is. There's just a different there's a different message coming from the investment community and the Fed now. And that really came into stark relief yesterday. Okay, interest rates. The Fed funds rate, that's their policy short-term interbank lending rate, but it influences all kinds of lending rates like home mortgages and auto loan rates and credit cards. It influences a lot of different lending rates. Anyway, this policy rate, the Fed says, is expected to rise to about 4.6% by the end of next year. So the Fed has, you know, in its set of expectations, a pretty continuous increase in rates until a year from now, so that's quite a distance from where we are at 3.25%. You see there with that rate, but you know, here again, the bond market has a slightly different message, and trading in Fed fund futures seem to suggest that the Fed's not going to be able or willing, I don't know which, to really raise it beyond 4.3% here in December of this year, in just a few months. And I think the reason for that is the next category, which is growth. I mean, the Fed can only pursue a really sharp tightening of financial conditions for so long before, you know, economic growth goes to zero and then goes negative, and then you're in a recession. So once that happens, you know, that's the great cure-all for inflation, and then the Fed has to lower rates. So I think investors are starting to think ahead, and remember that capital markets are discounting mechanisms. They're always looking ahead. Yes, yesterday's announcement was a shock, and that'll move the stock and bond markets for 1, 2, 3 days. But investors are starting to look forward beyond 2022 to next year, right? So we're not sure who's right yet. Nobody's sure who's right. Is the bond market correct that rates won't be able to go all the way as high as the Fed wants to drive them in order to kill inflation? You know, will the Fed be able to engineer this soft landing, you know, where inflation is moderated without driving us into recession? Will it not? No one's sure. But economic growth, according to the Fed now, is going to be about zero this year, 0%, and only 1% next year. Now, those are inflation adjusted, right? So if you take, in other words, if you take inflation out of the economy, we're not growing. We're dead in the water. And so that's obviously pretty anemic, right? When you consider the fact that over the long run, the Fed expects the economy to generate about 2% growth per year. So what they're saying here with these estimate revisions is, what we're doing is starting to work. We will be able to drive down economic growth. And key to that is the second bullet point there at the bottom. The Fed's goal is to soften the job market. And they said it in very explicit words yesterday. They said that they want to drive the unemployment rate up from about 3.5 or 3.6% where it is now, all the way up to 4.4% by the end of this year. That's a pretty short time span. And they want to basically do away with the fact that as of a month ago, I think there were almost 2 open job positions in this country for every unemployed person. And that's what the Fed calls a dislocation. This mismatch between like the availability of labor and the demand for it. And they see that as a real cause of inflation. And so they are going to work towards softening the job market in the coming months. Move past these, and I want to move right to the reality check. So, you know, how do we feel about this? How are we reacting to it? How are other investors reacting to it? I think it's pretty clear that we are seeing a growing disagreement between the investor class and the Fed. I cannot tell you how many interviews and articles I've read over the last 24 hours from, you know, big name investors saying, okay, I mean, this is enough, right? David Kelly, JP Morgan, again, why are we afraid of inflation? It's peaked, it's coming down. And he's saying, look, the Fed's running a real risk if they continue to sort of bull in a China shop this thing with these rate hikes. Some investors think, well, the Fed has to talk this way. Again, language is a tool. They have to do this now, and they really need to. They're trying to game the economy to sort of, talk everyone down from buying another car, or picking up that vacation home, taking the extra vacation, that sort of thing. They're trying to encourage employers to, basically stop hiring. Anyway, that leads me to the next point, which is this is a process, not an event. We can't look at one or two catalysts coming up. Like, we can't say, well, everything depends on the next Fed meeting. Everything depends on the midterm elections. We can't say that. There are bigger forces at work here, and this calls for patience, I think, among investors. This is a process, and it's going to take a while, because a lot of what I've been discussing really depends on the path of inflation. How quickly does it fall? And we just don't know that yet. So I've acknowledged the fact that the risk of the Fed moving too far is real, and that growth is slowing. We're going to put up with a period of anemic growth here. But the good news is that well, what Jeffrey Gundlach just said in an interview yesterday, people should not think about being sellers. They need to focus their attention on long-term investment returns. Again, the good news is that we're already a good portion of the way through this bear market. And this is not, what he's saying is, this is not the time to throw in the towel. A lot of damage has been done to the stock and bond markets. His view is that the bond market's damage is just about finished. He says there's a lot of view in the bond market, and we think that's starting to be the case. In fact, for clients within our moderately conservative or more conservative investment strategies, we just purchased some treasury bills because they give you a risk-free rate and return, and even with short-term, like 6-month bonds, you can still get, a 3.5 to 3.75% rate of return, annualized rate of return. So we think he's right. He also says that the stock market is closing in on a time where it will also represent pretty good value. I heard a stat the other day. 40% of the S&P 500 stocks. S&P 500 is like the biggest 500 companies in the U.S. stock market. So 40% of those trading below or at where they were pre-COVID. So all of that, excess that was brought about by COVID stimulus, and that's all been wrung out of at least 40% of these stocks. I want to also bring into this equation someone that I quote from time to time, Josh Brown, who's the CEO of Ritholtz Wealth Management, and his reality check yesterday or this morning was, okay, think about the average recession and bear market going back 80 or 90 years. What does that look like? Well, stock market on average drops about 31%. He said, we're already 20% through that. So you're 2/3 of the way through this already. And we don't even have to go to the average, but he said, we don't know. There might be some more downside in the market, might not. But he said, think about the numbers suggested by the historical record once you reach the bottom. And once you reach the bottom, the average return on the S&P 500 is like 21% over the next 1 year period. After that bottom, over the next 3 years, on average, you're looking at about 48% return, and holding, an investment for 5 years past the bottom, you double, which is 100%. So it just makes me think of another thing that Jeffrey Gundlach said, reminded us recently, which is that if you're waiting for the bottom and you think you can guess it, guess again. What happens nowadays in markets is that when you get close to the bottom, you need to start buying in, because there could be that one day where you get a favorable economic data point or a speech, piece of news that causes the market to just absolutely gap up, and you miss out. So he is recommending that clients start to buy now in stocks and bonds, and as things move lower, you focus on quality, which is exactly what we've been trying to do. Look for opportunities like those T-bills, because quality investments will spring load higher if something positive happens. So here again are our disclosures, and I'll just say thank you very much for tuning in. And if anything else significant happens in the capital markets or the economy in between now and our normal monthly video schedule, we'll come back to you with that. Thank you very much. Have a great day.